sobre todo en lo tecnológico, que es Corea del Sur. Nos acompaña hoy aquí en Negocios Televisión, en el plató, Catherine Yeung, que es directora de inversiones de Asia, ex-Japón, de Fidelity International. Catherine, thank you so much for joining us here in Negocios Televisión.
Thank you for having me.
Eyes on Asia, first of all, Catherine. Attractive valuations and lower inflation make the region's equity an attractive alternative to developed market stocks, which are now struggling a little bit more with high interest rates and the specter of a coming recession. Here in Japan, Japan is taking the leading role in Asia. What reasons are behind it?
So interestingly, when we look at when Japan was very much out of favor, we used to call it the lost decade. So 2 decades where Japan went through significant deflation. So when the bubble burst in Japan, you saw about a 70 to 80% drop in both stock prices as well as property prices over this 2-decade period. Over the past 10 years, though, because of policy, mainly stemming from Abenomics, we've seen the mindset change in Japan. So consumers, for example, companies are willing to take on that bit of extra inflation versus just living in a deflationary environment. You've also seen policy, for example, like the Tokyo Stock Exchange, say to their companies, we can't have 50 or half of the companies listed having a price to book below 1. So really look at your capital allocation, rewarding minority shareholders. So huge piles of cash are now being distributed back to minority shareholders. So the whole thought process and mindset in Japan really has changed.
Let's talk about China now, Catherine. China's economic slowdown, however, leaves a bitter taste in the region, in Asia, and a tide that could actually sweep the rest ahead. How cautiously should we approach to the Asian giant?
So at one end of the spectrum, you have all the flows going towards Japan, and China's at the opposite end. So China's probably one of the most disliked markets globally. If you look at valuations over, again, a 20-year period, Chinese valuations are trading their largest discount versus Asian multiples, and then Asian multiples trading their largest discount to the S&P 500. So again, I mentioned this mindset change we have in Japan. I think investors need to change their mindset and reset expectations when it comes to China. We are not going to see the big bang type of policy stimulus that we previously saw, whether it was in 2008. It's all about deleveraging for the Chinese government, as well as putting incremental supportive policies in place. And really, since the end of July, you've seen a number of smaller policies, but in aggregate, they're quite meaningful, come through. So with China, it's not a crisis of financial means, it's a crisis of confidence. And like Japan, the threat for China is that they could go into a deflationary environment. So people are often saying, is China going to be the new Japan? But again, this is why we're seeing so much support incrementally to ensure that they don't go through these lost decades.
In China, one of the problems now is the real estate sector, with Evergrande also as a threat towards China and this sector. It continues to cause problems 2 years later. Now, between trading suspensions, the focus is on a detained top leader in the company and the sector without being able to move forward. And meanwhile, economic stimuli that are of no use on the table. Do expectations have to be adjusted based on internal demand in the sector?
Very much so, both from a property sentiment point of view within China as well as from an investment perspective. So historically, at this juncture of where we are in the cycle, because we are starting to see this macroeconomic cycle come through, albeit it's been delayed and not as strong as we anticipated going into 2023. But property really used to be the backbone of the economy. And what happened was the private developers, such as Evergrande, they would be very aggressive with their property starts at this point in time. And they'd use the funding from pre-sales, because most Chinese people buy their homes off the plan. And then these projects wouldn't get completed. So again, it's this crisis of confidence. It wasn't they couldn't afford to pay the mortgages. They didn't know when their property was going to be delivered. So the state-owned developers have come in. And so you're expecting to see consolidation within the sector. These companies, they're well managed. They've got diversified land bank. They pay a very attractive dividend yield. So the shape of the sector itself has changed. Again, it's just that sentiment that needs to come through because it has a knock-on effect in terms of consumer confidence and spending there.
What does this tell us, Catherine, about the other great colossus of Asia, and I mean India? Because now India enjoys a greater prominence. It is already the most populous nation on the planet, and it's also favored by the United States. Meanwhile, we have this trade war between the US and China. How is this rivalry between India and China going to play out?
So, India, if you think about China not wanting to grow at the similar growth rates we've seen over the past 10 years, India, therefore, stands alone as the big potential growth giant in the region from a GDP perspective. Now, India, again, a lot of people refer to it as where China was 10 years ago, and, the growth of the consumer, it's got a very young demographics, but too much sort of attention hasn't been focused on the potential downside. We do have an election next year, so policy pace and implementation could change. When we look at India, they're highly dependent on imported oil. So far, they've received their oil from other sources. Maybe with the expansion of BRICS, including some of the Saudi Arabian countries and Middle Eastern countries, they could renegotiate better terms of imports. But essentially, they're highly leveraged to the global inflationary outlook. So something to be mindful of. But again, the long-term attractiveness of India is still very, very powerful.
And to complete the review, Catherine, I wanted to ask you about South Korea. Are you still interested in a country like this? It's a technological power, that's obvious. And with AI and chips, there is interest growing among this country. There are many challenges ahead. So how do you see South Korea?
So in terms of South Korea, it's got a population of about 51 million people, and global landmass is something like 0.1%, yet it's the 10th largest economy in the world. Now, we all know the big Korean chaebols or the big companies and the brands there, but where we find particular interest is with the small and medium cap companies. These companies, they've got global market share in really niche areas, whether it's, a laundromat for the semiconductor equipment, whether it's in biotech places or subsectors. So some interesting names there. The issue about Korea is they've got demographic issues. They've got incredibly high household debt to GDP. It's like 100% plus. And so there are some challenges, and also corporate governance. They don't reward minority shareholders like the Japanese companies are doing, like the Chinese state-owned enterprises are starting to do. So you have to be mindful of that. But then from a multiples perspective, we have seen a re-rating because of the full-on sort of obsession with AI and tech. The Korean companies are very, very technologically savvy. But again, you just have to be mindful of which companies you select there.
So amongst all the countries that we talked about, India, China, Japan, South Korea, do you think that the best option now to invest is Japan?
No, I actually think it's contrarian, and it's China, because while sentiment is so negative and poor towards China, the fundamentals of the companies are really attractive. Not all companies, but a lot of companies across a number of sectors. And what's really key to note is not only are they tapping into the domestic growth, the Chinese consumer is still alive and well, they're also starting to go global. So the rise of Chinese companies from a global brand and market share perspective is likely to continue to grow.
Catherine Yeung, directora de inversiones de Asia, ex-japón de Fidelity International. Catherine, it's been a pleasure to listen to you and to have you here in Negocios Televisión. Thank you so much.
Gracias.
Bueno, pues nos decía Catherine que quizá Japón todavía tiene unas características que pueden ser positivas, pero ahora mismo la inversión o la oportunidad de inversión quizá está más bien en China, que ya saben que ahora quizá está más denostada por la crisis que está viviendo ese sector del inmobiliario comercial y esa ralentización económica también que está viviendo. Enseguida volvemos a repasar los mercados financieros, pero antes voy a dar paso a mi compañero Javier Luengo, que nos va a hablar sobre Goldman Sachs y del aviso que ha realizado esta compañía, este gran banco de Estados Unidos, precisamente